If you're looking for a podcast that packs in sound property advice, as well as offering you an insight into making the world of property effective and ultimately work for you, you're in the right place. Hosted by Arsh, the original property rebel. He's written an Amazon bestseller, created the Property Investor app, the UK's first, and is an experienced property mentor. More importantly, he talks the talk and walks the walk.
Hi everyone, welcome to another episode of The Property Rebel with your host Arsh. And in today's session, we're going to be talking about the all-important topic. What is the best way to invest? Is it by taking interest-only mortgages, or should you consider capital repayment mortgages? Now, before we start, I'd like to quickly just say a hello and thank you to the subscribers and the new listeners to the channel. And hopefully you're going to take a load of golden nuggets away from the Property Rebel podcast. So let's get straight into it. What is the difference between interest only and capital repayment? Well, first of all, with interest only, it is exactly that. When you take a mortgage, let's just use an example. Just imagine that you're purchasing a property for £100,000. Now, on the basis that you get a 75% loan to value product, they will lend you 75% of the purchase. So that means £75,000 in this scenario. Now, on the back of that, let's just say that you've got an interest rate around 3% and the mortgage, I'm just using random figures here, the mortgage payment is around £250 a month for argument's sake. Every month you will pay £250 a month, and no, you will not chip away at the debt. That interest is simply interest that you're paying to the bank or the lender. Now, the benefits of having a interest-only mortgage is that it keeps your payments lower. However, one of the negatives is that you're not chipping away at the debt. And we'll go through this in greater detail in a minute. Now, with capital repayment, the clue is actually in the word repayment. So what you're doing is, yes, you're paying the interest element as we discussed above, but instead of your mortgage payment being circa £250 a month, it may now go up to £400 a month. So the £250 element was the interest. The £150 surplus that you're paying now is actually chipping away at the debt. So give you a little story as to what I do and how I've structured this with my portfolio. So taking me back to 2007 and 2008, I was pretty much at the brink of going bust. And this is all very well documented in my book, Boom, Bust and Back Again, which is available on Amazon. It's an Amazon bestseller. By the way, that's not a plug, just for reference. And what happened in 2007, 2008 is that I actually had a development company with my brothers who were the directors in the business. And as a result, what happened was that we were building houses and apartments. At the time, we had around 200 apartments being built. And as a result of that, we had approximately a 20 to 25% margin in the whole development job, which is on average the kind of profit margin that a developer looks to achieve. But when the market downturned and the market crashed, surveyors were actually downvaluing stock by circa 30%. So therefore, it actually made it unviable to actually build. So we had to close that development company down. Now, as a result of that, we looked at our portfolio, and at that point we were all only on interest only. And when we looked at where we were, because the market crashed and because the houses and the prices took a dive, we found that we were pretty much in negative equity, and we had to have an uncomfortable conversation with our bank manager. And he came to us and he says, guys, okay, this house is worth 100 grand. It was worth 100 grand when you bought it. It's now really worth circa 80 grand because it's dropped by 20% or 20 to 30%. However, our lending on this is circa around 75 grand plus some fees, so about 80 grand, which means that we're 100% geared, 100% leveraged on that property. And Lloyd's, who was the lender at the time, said, we're not very comfortable with being 100% geared on a portfolio, especially in a downwards market. So they came to us and said, guys, you've got two options. You can either start putting money back into the portfolio, and they were asking for money that we didn't have. So they were saying, come on guys, okay, let's get back to our lending parameter. Now, if the property is worth 80 grand now and our lending criteria is 75% of that, that means that you've got to put in 20 grand. And you've got to remember, we've got quite a few properties. And so that was not a financially viable option for us. So what we then did is that we talked with the credit team, we spoke and we restructured all our loans so that we structured it over a period of time so that they're all on capital repayment. This triggered a revaluation, and as a result we spent tens of thousands of pounds on valuations and getting the structure back in place. But now we put them all on capital repayment. And it's probably one of the best moves that I think I've ever done. And the reason being is that since 2008, going from 2008 to pretty much being 100% geared with Lloyds, now down to we're in 2020, we're approximately 50% geared. So we've been chipping away at the debt every month. So we've had to make sure, and this has been a real stress test for us because our mortgages are probably slightly more expensive than obviously the interest only, but we've had to make sure that the rents have been coming in. We've had to make sure that everything's been, and all the services and the overheads have been covered. But as a result of that, now, back in 2008, I said to myself that I never want to be in this position ever again. And thinking about it now, I'm so glad that I said this because no one knew that COVID-19 was going to come in 2020. And as a result, now I sit here in a very fortunate position where regardless what happens in the market, whether the market increases or whether, so we in the property market, we go through peaks and troughs. At the moment, we're going through a trough. So we're about to go into a nosewood dive as we head into recession. And what's going to happen is that our property prices are going to plummet. And that doesn't really bother me right now. The reason being is A, I've got no intention of selling. And B, because my portfolio is on a capital repayment basis, I know that I've got more than enough equity in my portfolio to cover any downward fall. So if the property market was to take a 20% dip, because my portfolio is only geared at around 50%, I've still got another 30% worth of equity there. So I'm constantly in equity. Now, back in 2007, 2008, I said I never wanted to be in this position ever again. So what I did, I structured all my loans on a capital repayment basis, and I structured them to a specific date. I structured them so that on the 11th of November 2025 at 11:59 p.m, all my debts become zero. So all my loans go to zero. So my portfolio will be completely debt-free. Now, why did I choose such a specific date? The reason is very simple. Because on the 12th of November 2025, I actually turned 45 years old. And at that point, I'm completely debt-free. Completely debt-free, so no portfolio, no money loaned against any of the portfolio. And on that point, actually, we've structured it so that my daughters actually inherit the portfolio, so it's a tax efficient process as well, and it will work extremely well. Now, the benefits of a capital repayment is, yes, it's going to cost me a little bit more over the period. However, when you look at it from another point of view, is that I'm getting to a point of debt free. Now, the people that are on interest only, now there's nothing wrong with being on interest only. I should make that clear, and I should actually put in a disclaimer, should from the start, saying that this is not financial advice. This is literally based on my opinion and my experiences. But the people that are on interest only, it's almost like a form of gambling. And the reason why I say it's a form of gambling is because what happens at the end of your 20-year or your 25-year term that you've got with your mortgage lender? Can you guarantee that you're going to be in a peak or a trough? Now, if you're in a peak, you're in a win-win situation, because not only have you benefited from some capital growth, but also you've benefited from low mortgage payments. But what happens when you come to the end of the mortgage term and you're in a trough and your property is actually in negative equity? You're now having to become a motivated seller to sell that property to service the bank. And this is the thing that I did not like about an interest only. You are a slave to the bank. And I hate to say it, and I apologise if you are a person that has a portfolio on interest only, and I'm hoping that you start to rethink about this, or think about this in a slightly different light, because capital repayment, there are lots of benefits to it. First of all, I treat it like a piggy bank. Every month we pay our mortgage payment, every month a little bit more debt is coming off. So we're chipping away at it day in, day out. Regardless what happens in the markets, whether we go up, whether we go down, we're in a win-win situation. If the market goes up, guess what? We've just doubled in equity. If we come down, believe it or not, we're still in a good situation because we've still got lots of equity in our portfolio and we don't need to become a motivated seller. The other benefit that I will say to you is that if you calculate how much interest you're actually paying to the bank over a period of time, just on interest only, you're actually near enough paying for the property twice over. Whereas in my scenario, I've paid the interest, but I've also got the equity. So I'm in a much better position than as if I was in an interest only. Now with my capital repayment, what I tended to do, or what I started to do, is literally instead of structuring it for 2 or 3 or 5 years, which you can do, I went, because I'm with a commercial lender, I'm with Lloyd's Commercial, I structured the loans for 20 years at a fixed rate. Now you could say that this is a good move or a bad move, depending on which side of the fence that you sit on. Now I structured it at 3% above base. Now the reason why I did that, very simply, now at the moment base rate is very, very low. It's literally 0.25, so a quarter of a percent. So my mortgage payments around 3.25%. Depending on where you sit, on which side of the fence that you sit on, you could say that that's actually quite expensive in today's market. And I completely agree. And the reason why I say that is because there are cheaper products out there. Now, if I was on a flexible rate, I would literally be paying a quarter of my mortgage payments. And some of you could say, well, in actual fact, why doesn't Arsh just save the difference and pay off lump sums? Well, that's one of the benefits of being on interest only. You can pay lump sums off your mortgage. So, but you can only pay up to around 10% per annum off the debt. So you can't go and say, Lloyd's, okay, my loan is 70 grand, here's 70 grand. Not within a fixed period anyway, potentially in a flexible term, then yes. Hopefully I haven't lost you, because I feel like I'm scouting about or jumping about a bit here. So going back to interest only, on interest only you can make repayments, but in lump sums, and that will come off as debt as opposed to interest. But you've got to be able to be disciplined in that. So you've got to be able to save the cash flow and then every year say, guys, okay, boom, here we go. Now, for me, that wouldn't work. And the reason why I say that wouldn't work is because the cash flow that we generate, we buy more property. We buy more and more property. If it was a choice of putting it into my existing portfolio to drop down the debt or buy more property, naturally buy more property would win. That's why another benefit of capital repayment. Every month, I don't need to worry about it. It's already taken as a direct debit. Taken as a direct debit so that therefore everything's paid. So anything that I know that's surplus in my account is now funds for me to go and buy more property. So I'm hoping that you're seeing the vision as to why I've done this. So I've structured it so that first of all my loans come to zero at the point of the 12th of November 2025. I've structured it so that every month we're chipping away at the debt. I've structured it so that my children can inherit the portfolio over a period of time, and regardless of what goes on in the market, I'm in a much better position. I don't need to worry about banks knocking on my door. I don't know. All I've got to do really is make sure that those properties are fully tenanted, and that's the only thing that I really need to do. So guys, it's a bit of a shorter session than normally, but hopefully that's got you thinking, well, have I got the right portfolio, or have I got the right kind of lending? Is this my goal, or do I want to be? You've got to think about your goal. Where do you want to be? Do you want to be in a position where you want to hand a portfolio over to your children, or to create a legacy for your family, and be in that position where you can hand it over, say, kids, okay, the hard work's been done. Here's a completely debt-free portfolio. You know, you've got a load of cash flow. Do what as you please. Or do you want to say to them, guys, okay, we've got a portfolio. Here's a debt level. You still got to service that and go from there. For me, I'd prefer to hand it over knowing that they're not going to be a slave to the bank, as I've been probably for the last 20 years. So something to think about, but hopefully you've enjoyed the session. If you want to know a little bit more about the Property Rebel, you want to know a little bit more about Arsh, feel free to check out Arsh on your social media platforms. So you can find him on YouTube, you can find him on Instagram, Facebook and Twitter. and LinkedIn. More importantly, if you haven't already done so, please download the Property Investor app. It's the UK's first property investment platform which showcases all kinds of property deals all over the UK. So we've got below market value deals, rent to rent deals, lease option deals, development deals, service accommodation deals, you name it. And to get access to it, all you've got to do is go to www.propertyinvestorapp.co.uk, or alternatively, if you've got a smartphone, go to the App Store in your phone and type in Property Investor, and it will be there. It's completely free to download, takes approximately 2 minutes to register, and you'll see all the deals across the country. So hopefully you've enjoyed the session, and I look forward to speaking to you all very soon. Bye-bye.
The large majority of people make a positive change if they take immediate action. So act now. Download the Property Investor app and join Arsh on his social media channels to excel your property journey.